Hey there, money movers. Welcome back to Money Trap, your number one spot for making sense of your sense. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss a chance to empower your financial future. Today, we're tackling a topic that might seem a bit intimidating at first: stocks and bonds. But don't sweat it. By the end of this video, you'll be throwing around words like dividends and yields like a Wall Street pro. So, buckle up and let's ride. Up first, let's talk about stocks. When you buy a stock, you're buying a piece of a company. Let's say the company is a pie. Buying a stock is like buying a slice of that pie. You become a part owner, or a shareholder. The bigger your slice, the bigger your stake. Why would you want to buy stocks? The goal is to buy a piece of a company that you believe will grow over time. As the company's value rises, so does the value of your stock. This is called capital appreciation. But wait, there's more. Some companies also pay out dividends or a portion of their profits to their shareholders. So you can earn money in two ways: from the stock's price going up and from dividends. But remember, with high reward comes high risk, and stocks can sometimes be a wild ride. If a company doesn't perform well, the value of your stock could drop. That's why it's important to diversify your portfolio, or spread your investments across different companies and sectors. Now, let's move on to bonds. If stocks are like buying a piece of a company, bonds are like lending money to a company or to the government. In return for your loan, they promise to pay you back with interest over a certain period. This is why bonds are often referred to as fixed income securities. Why invest in bonds? They're generally considered safer than stocks. You know exactly when you'll get your money back and how much interest you'll earn. This makes them a good choice if you're saving for a specific goal in the near future, or if you're a more conservative investor. But bonds aren't risk-free. If a company goes bankrupt, it might not be able to pay back its bonds. And while the interest rate is fixed, it might not keep up with inflation over time, which could erode your purchasing power. So, stocks or bonds, which is better? Well, it's not about better or worse. It's about what's right for you. Stocks can offer higher returns, but with higher risk. Bonds are more stable, but with lower potential returns. A well-balanced portfolio usually has a mix of both. Now, let's talk about diversification. Diversification is like not putting all your eggs in one basket. You spread your investments among different types of assets, not just stocks and bonds, but real estate, commodities, and more. This way, if one investment does poorly, it's less likely to sink your whole portfolio. But how do you diversify without having to buy hundreds of different stocks and bonds? Enter index funds and ETFs. These are investment funds that automatically diversify for you, often by tracking a specific market index. For example, an S&P 500 index fund invests in the 500 largest companies in the US, giving you a small slice of each one. Another option is mutual funds. These are managed by professional fund managers who pick and choose investments with a specific strategy in mind. They're a good option if you want a more hands-off approach, but they often come with higher fees. If picking individual stocks, bonds, or even funds feels overwhelming, you might consider a robo-advisor. These are automated platforms that create and manage a diversified portfolio for you, based on your risk tolerance and financial goals. Alright, now you're equipped with the basics of stocks and bonds. So, how do you get started? First, set clear financial goals. Are you saving for retirement? A down payment? Next, determine your risk tolerance. Can you stomach big swings in the value of your investments? Or do you prefer more stability? Once you're clear on your goals and risk tolerance, the next step is to open a brokerage account. This is like a bank account, but for buying and selling investments. There are plenty of online brokers to choose from, so do your homework to find the one that fits your needs. Remember, investing isn't about getting rich quick. It's about growing your wealth over time. The key to successful investing is consistency. Regularly investing money, no matter how small the amount, can add up to big returns over time thanks to the power of compound interest. So, there you have it, folks. A crash course on stocks and bonds for the everyday person. Remember, everyone can invest. It's not about having a lot of money. It's about understanding your options and making smart, informed decisions. And as always, don't forget to consult with a financial advisor or do thorough research before making any big investment decisions. That's it for today's video. If you found this information helpful, be sure to hit that like button and share it with your friends. Remember, knowledge is power, especially when it comes to your hard-earned money. And don't forget to subscribe for more financial wisdom from Money Trap. Until next time, keep trapping that cash.